Retirement plans and their taxation can be complicated subjects, and it's important that you're able to advise clients regarding them. Remember to always suggest that a client seek the services of a tax expert. Ownership of a life insurance policy determines who controls the contract, and we examine issues with both first and third-party ownership. Then we looked at insurable interest requirements as well. The processes for viatical and life insurance settlements are similar, but there are minor differences. Both are arrangements where the policy is sold to a third party, and when the insured dies, the settlement company receives the death benefit. But to enter into a viatical agreement, the insured must either be chronically or terminally ill. This isn't the same for life settlements. Then we concentrated on group life insurance and how it differs from individual life. The owner of a group policy is called the sponsor. Employers are the most common sponsors for group plans, but others offer them too. Banks and other creditors, associations, professional organizations, and more. Employers cannot be the beneficiary of an employee's group life coverage, but for other plans, they may. Plans where the employer can be the beneficiary are business life insurance plans, which are individual contracts. Buy-sell agreements and key person insurance can be critical to continuation of a business in the event an owner or someone key to the business operation dies. We began exploring retirement plans with a discussion of qualified versus non-qualified plans. Then we went on to 401ks, simple plans, and more. Employee benefit plans are a great recruiting tool for employers and tend to attract higher number of applicants when they're offered. IRAs were studied too. There are traditional IRAs that allow the possibility of tax deductions and are available for anyone with earned income. Roth IRAs are primarily intended for the middle class. There are substantial differences between the two, and both have tax implications as well. We took some time to discuss the Social Security retirement benefits, as well as payments for spouses of deceased workers, children, and others affected by their death. Tax treatment of premiums, death benefits, and cash values contained within permanent life policies was up next. For the most part, this type of insurance receives beneficial tax treatment. Death benefits are typically received tax-free by the beneficiary. Cash values grow on a tax-deferred basis, and the IRS allows cost recovery if a policy is surrendered for its cash. If a death benefit is taken as a lump sum distribution, it's tax-free. If an option is selected that pays the distribution over time, each payment will be part death benefit principal and tax-free, and part interest, which is taxable. This is defined by the exclusion ratio, a formula that determines what portion of the payment may be excluded from taxation. Finally, we looked at the IRS's 7-pay test. If a life insurance policy fails the 7-pay test, it changes permanently to a modified endowment contract, and it changes the tax picture significantly. MECs are taxed more like an investment than life insurance. Policy loans and surrenders are also adversely affected. However, the death benefit is still tax-free.